Buongiorno, siamo in compagnia di Matt Eagan, gestore di Loomis. So, Matt, tell us the effects about the quantitative easing of ACB for the next month.
Well, the effects of quantitative easing are pretty much priced into the market right now, which is that yields have collapsed. We're starting to see the euro weaken considerably, and I think what is likely to transpire in the future, which is consistent with what's with other areas where quantitative easing is taking place, like the U.S. and Japan, which is corporate bonds are likely to continue to perform well. So people are pushed to get yield somewhere, and corporate bonds can provide that. And also, I think equities. I know we're here to talk about fixed income, but I think equities can do well in Europe as people allocate or shift portfolios from fixed income to equity as well.
And for European investors, which are the opportunities in fixed income in Europe?
So I think when we look around Europe, I think what's pretty evident is you're not getting paid to take term structure risk in most government bond markets. Pretty much the northern European markets like Germany and such, we have negative yields out to the 5-year. And that's a result of quantitative easing. That's a result of a technical bid for high quality paper. And I wouldn't read too much in terms of what that is suggesting about the forward curve in terms of fundamentals. In other words, you're not really getting paid to take risk in those markets. So we would advocate looking outside of those high quality bonds. I think in some areas in Europe in the peripheral, I think some of the sovereign debt can continue to contract versus bonds. But I think what's even more attractive are corporate debt. I think there's going to be a lot of issuance in the investment grade area for corporate debt because of the demand for yield. And I think high yield is an area which sold off a lot towards the tail end of 2014, mainly due to oil markets and the effect it has on that sector. I think now looks attractive. You're getting 400 basis points of excess yield, which is quite attractive. So those are some of the areas that we're focused on right now.
And let's talk about the situation in Greece. What are the risks for investors?
Well, clearly the negative outcome would be a Greek exit from the euro zone, and I think that's a low probability event, but not completely out of the question for sure. But I do expect here we have another reprieve here where the governments can come to terms. I think that there is a high bar for Greece to leave the eurozone. I think that most want them to stay in for a lot of different reasons. But the risk is that they leave, and I think that would be destabilizing, and we could see again a flight to quality and some of the risk assets trade off. But I think it's a lower probability event. More likely they stay in the eurozone, and this gets pushed out further.
And finally, the emerging markets. Where are the opportunities, if there are?
Emerging markets is going to be a tough sector again, we think, in 2015. And there's really two reasons for that. One, we think commodity prices are going to remain challenged. So a lot of emerging markets that depend on high commodity prices won't get that this year. And I think the other reason is that with the U.S. Fed likely to start to tighten monetary conditions, that means a lower amount of global dollar liquidity in the market in the world, and that tends to be challenging for countries, particularly countries with large current account deficits like Brazil, South Africa, places like that. But EM is a broad space. It's hard to put generalizations. I think it really comes down to picking the right area. So through our research, we're focusing on certain countries that we think have made enough reforms that can handle a tighter Fed and maybe are less commodity dependent. And a market that might fit some of those characteristics would be Mexico, for example, which has made great reforms over the past few years. Has oil, but not overly dependent on oil. So, and that's a market you can pick up 400 basis points of spread over high-quality government bonds in the developed world.
Okay, thank you, Matt Eagan.
Thank you.